Hi, welcome back to the channel. Now, before I do the usual and switch over to my screen share and walk you through all of the charts and the data that you all tune in for, it's of course been a really wild few weeks. A lot has happened. I hope my work in our last analysis around a month ago has helped in some way. It has continued to be incredibly choppy, but also with some massive upside moves. And in this video, I'm going to walk through many of the key charts and the data that I think matter. And as always, I will have a high level, broader market analysis with some key stocks and ETFs that you can add to your watch lists going into earnings season. Now, you'll probably find a lot of value from my work. Everyone's asking if the market has already bottomed, or is the big credit event, economic collapse everybody's expecting just around the corner. On one hand, you've got all of the perma bears screaming that it's just a matter of time, and on the other hand, we have the bulls screaming that the market bottomed in October. Add in all that we have the mainstream media clown shows and also the Fed talking every 5 minutes. It is incredibly tricky for everyday investors, and I think being open to all possibilities makes sense. Managing risk is, as always, priority number one. Now, investor sentiment is showing that there is some greed out there. It's all set against a backdrop of all of the usual negative news headlines and all the negative catalysts. Now, before I get into these charts, for disclosure, myself or my clients may already hold some positions in some of the names mentioned. And if you are new to the channel, I like to use a combination of technicals and fundamentals, and I'm told that I'm very, very good at removing a lot of the confirmation biases from my charts that you'll typically see across social media. As most of you know, I do not use the magical hindsight indicator. I timestamp all of my work, which is massively important. I'm not a short-term day trader looking for little $1 or $2 moves. I'm looking for structural trends that will last weeks to months, and I like to use systematic process. I'm told that my charts are among the very best in the business, so hopefully they make sense, and if they don't, let me know in the comments and I'll do my best to point some information out to you. But my ability to highlight the big risk on, risk off turning points at the right time is well documented. I'm not one of those traders or analysts who make broad market calls 6 months before they actually play out. I'm able to call it in real time. Some of my recent time-stamped calls, the market crash 1 year ago was a big one. The rotation from growth into value, bear market rally last June, the exact top in August, the exact top in the US dollar, the market bottom in October, the bottom in bonds, and the recent rotation back into technology stocks. And you can go all the way back to the crash of 2020, where I got our clients and members defensive ahead of that as well. So I do have a track record of being mostly correct, so hopefully that it gives some idea as to what you can expect. And if you do find value from my work, please do like, share and subscribe on YouTube, and feel free to subscribe, follow and share on Twitter as well. But please do pause the video, make sure you're comfortable with that. Very important disclaimer before watching any further. And enough about me, let's dive into some of the charts. Now, as always, I will start off with the yield curve. Now, the yield curve, as we all know, is inverted. We know that the inverted yield curve is a very good indication of an oncoming recession. The shaded areas are recessionary periods, and we can see that we're being told that we're still not in a recession. Now, something that I think is being overlooked again, the shaded areas represent a recession. We've already had 2 consecutive quarters of negative GDP, but for whatever reason, the goalposts have shifted, and this is no longer the data that we use to determine whether or not we are in a recession or not. Now, in my world, I call that shenanigans. Now, I have taken it a step further for this month's analysis, and I've walked through previous recessionary periods dating back to the 50s. Now, what I find very, very interesting is, whilst we haven't yet been told that we are definitely in a recession, I don't know about you, but it feels like a recession. Inflation going through the roof. We've got job layoffs. There's not a lot of positives to say really about the economic conditions. But if we look at the previous quarters of negative GDP, and we forward look, and we can look at historically what the percentage declines have been from the moment that a recession has been announced, we can see that over history there have really only been three, I would say, catastrophic instances and declines in the S&P 500. 1973, we've got 2001, and we've got, of course, 2008. The rest of the declines, whilst they are quite severe, are typically what we would find with any standard corrective phase in the market. If we talk about 11% declines, 19, 15, 12, what I find very, very interesting is if we had classed the negative GDP last year as a recession, that would have equated to a 21% decline, which is in line with previous recessions. So I guess what I'm saying here with the analysis is the economic conditions are, of course, not terrific, but the S&P 500 has declined in line with previous declines. And of course, if you have followed my work for longer than 5 minutes, you'll know that I was making bullish calls at the market bottom in October. And of course, we're constantly looking forward. The S&P 500 is trading above its 10-month moving average, which is a very good risk-on, risk-off indicator. So for me, I am still currently looking at buy positions in the market, but of course one very, very close eye on any potential catalysts that could tank the market. But the stock market is being incredibly resilient at the moment. We can drill it down to the shorter term time frames of SPY, and we're at this 50% retracement level from the January 2022 declines, and I think we're actually looking quite constructive for a potential breakout going into earnings next week. Of course, we are going to have to see how the reaction to earnings is, and what the mega caps announce. We have Google, Amazon, Microsoft next week, so it promises to be a very choppy and incredibly challenging week. We're also seeing across the board the S&P 500, a lot of defensive areas of the market are catching a bid. The utilities sector, of course, healthcare and consumer staples have recently been performing incredibly well as well. So there is a lot of defensive positioning out there. But to the other side of that, the obvious defensive asset to own is, of course, gold. The big question I have at the moment is this a level in the market where we can maybe expect a little bit of consolidation, digestion of gains. We've got gold hasn't quite broken out to new all-time highs. We've got the junior gold miners potentially putting in a failed breakout, and the big question is, are the gold miners going to follow the junior gold miners and really just pause across the board? So for me, gold upside objectives have been met. Really, it's just a case of standing aside and watching what comes next. We've got the NYSE composite. Again, I'm looking at this 16,000 level. I think the NYSE composite is a far better gauge of the market than the S&P 500. And of course, we've got the All Country World Index. Stocks around the world The individual sectors around the world are all pushing against all-time highs. Many are breaking out. And the big question is, could the S&P 500 just follow what's happening around the world? I think it all starts with the All Country World Index. I think if this gets above $94, then I think given the correlation with the S&P 500, then that would be another potential bullish catalyst. But I can't emphasize enough, it really comes down to really what happens over the course of the earnings season, and it promises, as I said before, to be incredibly choppy and challenging. Key to it all also is the US dollar. The US dollar is range bound. Well, why is the US dollar so important? Again, the inverse correlation with the S&P 500. If the dollar is going down, then stocks are going up. So the big question I have at the moment is the US dollar index about to fall off a cliff? If the US dollar index is about to fall off a cliff, then I think it's quite reasonable to expect the S&P 500 to go up. That's not thoughts and feelings, that's really just what the chart is telling us. I think it's quite obvious with the way that the chart has been presented. We've got XLF continuing to be incredibly resilient in the face of all the negative banking financial sentiment out there. So the economists look like they've nailed it again, calling the bottom in XLF, but again, we'll see how things develop over the course. We've got the Dow Jones Industrial Index again about to push against those recent highs there around 345, and of course we've got the small caps starting to look quite constructive if it can break out here above that 180 level, and again I think that's another potential bullish catalyst for stocks. And we've got the micro caps, which have done a whole lot of nothing over the course of the last few weeks, continuing to just chop and be incredibly range bound, not appealing or interesting to me at all. But again, to the other side of things, I am very much aware that the major averages can take the rest of the averages with them. So potentially if the micro caps fall off a cliff, that could then take the small caps, which then take tech, and you get the idea. So that's the way that I look at things. And of course we've got the triple Qs chopping about over the last few weeks, and I think the logical upside there is the 335 level, which would represent the August 2022 highs. That's the thesis that I'm working with at the moment. But again, I think if the triple Qs are to break down below these levels, then again that's the problem. And again, just to emphasize and re-emphasize that I think it all comes down to what we see from the mega cap names over the next couple of weeks. Now, I'm about to get into around 20 individual stocks and ETFs that I think you can add to your watch lists. If there are any disclosures, then they are. I have marked them on the charts, any names that we've been recommending to clients, etc. But if you are still here, it probably tells me that you're getting a lot of value from my incredibly hard work. It's all free. So please do hit the like button. It would mean the world, and it helps to get my work noticed and out there. And if you have social media followers, please do feel free to share with those as well. But let's start off with XLK. The XLK, very, very similar to the triple Qs, is chopping about sideways. But within that, within technology, we have a lot of names that are looking incredibly constructive. Amazon, again, for disclosure, I've made a bottom call on this one 10 days ago. It is now above its 200-day simple moving average, or it's closed on its 200-day simple moving average, I should say. And going into next week, it'll be very, very interesting to see whether or not there is a breakout here in Amazon. We've got Microsoft, again, reporting earnings. I think if it can break out post-earnings above that 295 level, I think that would represent a very logical 19% upside. We've got Berkshire Hathaway. Again, if the world was ending, I don't think Berkshire Hathaway would be breaking out. So I think above 320, I think it has put in a breakout. This was one of the charts from our premium work last week. It looks to be breaking out. Again, we've got Google here, potentially shaping up. I like it above that 110 level. Now, CBOE might not be a name that you would potentially gravitate towards, and I get it. But what I want to draw your attention to with this has been basing for 6 years, but this is one of my first loves, and this uptrend was incredibly beautiful. And when stocks have got a history of trends in that manner, it's not a guarantee that we're going to see the same thing. Of course it's not, but it does tell me that when these types of charts and these stocks start to trend again, we can get some big moves to the upside, and when it does put in these uptrends, it does look to be quite smooth and sailing. So I like CBOE above 140. We've of course got Apple, again recommendation, but we've got a target there of around 180 to 182. We'll see how things develop there. Nvidia, I get asked about Nvidia literally every week. Now, obviously with something like Nvidia, I am incredibly mindful. Let me just draw your attention to something. With Nvidia, there's a very obvious bearish divergence. Now, over the course of the last couple of weeks, I've seen head and shoulders top patterns all over the place, bearish divergence, etc. But what my process and systematic process is really built upon is filtering out all of the news that makes everybody make impulsive decisions and sell winning positions. So for me, I like to use an average true range trailing stop loss. There's no fluke here that this trend has remained intact since I made a bottom call there in January. I am aware of the bearish divergence. I am aware that it is looking a little bit toppy here, a little bit of trend exhaustion. But ultimately, it doesn't matter what my thoughts and feelings are. I simply just remain in the trend, and of course I am hoping that it continues to move higher and reaches our ultimate objectives here. But I think if you are looking to enter into Nvidia at this late stage, I think it's very, very tricky and challenging. For me, the entries, of course, are way down here. Hindsight tells us that. But I think if you are looking for a new entry, I think it would need to be above that 290 level. I think in here it's going to be very choppy, very messy, and honestly that this could go in either direction. I am a holder of Nvidia. I've got many of our clients are in Nvidia. I'm doing very, very well from it. But again, it's got to break out above these levels, and if it breaks down below these levels, then again, thank you very much, Mr. Nvidia, and put options might make sense. Again, very, very similar with Meta. I'm asked about it all the time because I've been covering this since January, even on my YouTube channel. Again, I am still working with upside objectives here around 235, but very, very similar to Nvidia. I am very, very conscious of a bearish divergence here, but ultimately again, the trailing stop is up at 205, and ultimately see how far it wants to go. But these are the key levels. I think that 200 level, I think 235 also. Salesforce potentially breaking out. Now they've put together a massive share buyback, so potentially above 200 might make sense there for Salesforce. We can look at SMH as well. Provided these levels hold around 244, then again I think you can continue to be bullish on semiconductors. But again, going back to what I've been saying about Nvidia, etc., be very, very mindful that the semiconductor space could fall off a cliff. The percentage gains that have been had in Nvidia this year, AMD to a certain extent as well. The market can't sustain that. There are always rotations in and out of various sectors. So my work at the moment is really focused on, well, if the money is going to come out of semiconductors, where else could it potentially go to? And that's why, making bottom calls on stocks like Amazon makes sense, because they're obviously great companies, and certainly we're just looking for value and areas of the market and good levels to buy stocks. CDNS, I covered this one for the last couple of months. I was asked about it this week. Uptrend is still intact. 205 I think would make sense, but it's broken out of a double bottom chart pattern. Tesla has been a big one this week. Now, I posted this chart to Twitter after earnings, and what I'm looking at here is a very obvious zone. We're looking at the 61% Fibonacci retracement level and also fill the gap. Now, I haven't done anything here with Tesla yet. I'm wanting to see how things digest. Again, I made a bottom call on this one back in January with the capitulation. So if we get another capitulation event, I would hope most of you understand that buying capitulation on good stocks makes a lot of sense. I would put Tesla in the good stock category. But again, I'm looking at this zone here. If it pulls back to 145, then great. But one thing I want to draw your attention to is the stock has not reached an oversold condition. That is a characteristic of a stock that is moving higher. I think the problem would be is if it reached an oversold condition, then what you tend to find is that it will reach an oversold condition, and then RSI typically can't get above that 50 to 60 range, and then it starts a downtrend. So that's something I'm watching with a lot of interest at the moment with Tesla. We've got Netflix. Again, the uptrend is still very much intact. If you were watching the earnings and the volatility that came with that, then for those that maybe were holding puts, it must have been incredibly frustrating to see the rebound after hours. But for me, the uptrend is still very, very much intact, and I think above 370 would be a decent spot if you are looking to buy into the stock for a potential breakout. Nike, again above 131. We've got Samsara. Now, this will likely be a name that you've not heard of. It came onto my radar this week because one of my clients asked me for a chart on it, for a chart request, and I provided a bullish chart at 1992, posted it to the rest of our clients and members, and it's of course doing pretty well. It is breaking out, but Stan Druckenmiller is an investor in Samsara, and I think when Stan Druckenmiller is buying into stocks, I like to pay attention. So it is breaking out. The downside to this stock is the CEO has been dumping shares recently, so that's of course a red flag. But the stock is breaking out, and we'll see how things develop over the course of the next few weeks. Merck, one of our premium charts, potentially breaking out in the healthcare space, of course. 20% further upside. We've been covering this one for a few months. I like it to 138, provided these levels hold. But what we are starting to see in the healthcare space is rumours and company acquisitions, etc. So it wouldn't surprise me in the slightest if Merck start to announce some purchases, but again, we'll see how that plays out. It's all rumours and conjecture at the moment. JP Morgan, upside objective here around 144. We've got Barrick Gold. Now, this will very much depend on what happens with the gold miners next. I did present a chart at the beginning of this analysis, and if the gold miners, if GDX and GDXJ can catch some kind of bid over the next couple of weeks, then Barrick Gold might make sense. It is basing, but for me it does need to get above that $20.50 range. C Limited, again, we've got entry levels there around 92. Steel Dynamics, again, above 115. One of our recent buy low, sell high charts, and again above 115 would make sense for a potential breakout in an area of the market where we have lots of low PE ratios. A lot of the companies have solid 12-month earning growth, but again, above 115 I think would make sense for the next entry into that. Now, I posted this chart to social media this week, just highlighting how I like to use relative strength analysis. Now, the gaming sector, I'm assuming, won't be a sector that many of you invest in, but there's some really big names in there, big market caps, etc. They have broken out over the course of the last week. We've got strong relative performance to the S&P 500. We also have Germany. These are charts, I should say, that are from our ETF chart books. So we've got Germany potentially breaking out. I think there's 24% upside. I did mention at the start that a lot of Europe is breaking out, and a lot of Europe is now pushing against all-time highs. So Germany, EWG might make sense there. We've got the cybersecurity. Again, I posted this chart to Twitter, potential inverse head and shoulders pattern. I did note that it rejected at the 40-week simple moving average. This is a confluence of price resistance levels, and when you get a breakout above a confluence of levels, in this case we've got historic resistance, we've got a trend line, and we've got the big moving average. I think if there's a breakout above 24, I think there's a lot of buying that comes into a beaten up area of the market. There's lots of beaten up areas, let's not beat around the bush with it, but there are a lot of areas that have been absolutely incredible over the last couple of months. The sugarcane ETF is now approaching upside objectives. I have been covering this on YouTube for the last couple of months as well. I have been asked about it, so again, this is still the chart and still the target that we're working with. One of our buy low, sell high charts, which is essentially range bound charts. The Biotech's XBI, we've got $95 for our target there. Again, the IBB, very, very similar. One of our buy low, sell high charts, 138. And of course, if we are bullish on biotechs, then we have to look at the biotech companies. And of course, that leads me to stocks like Biogen, which again, one of our buy low, sell high charts, potentially looking to break out, I think, above $300. And I think there's another potential breakout there in Biogen. So I hope you've had a lot of value from this analysis. If you are somebody that perhaps struggles a little bit, and maybe you're looking at my work and want to do it a different way, then feel free to stick around for a minute. But please do hit the like button, share, let me know in the comments what you think of the analysis. Have I got it right? Have I got it wrong? Let me know. I love hearing your thoughts. But if you are new to my work, what I do, feel free to go and jump on our website at honeystocks.com. We provide memberships to our clients and members. We provide every single weekend our premium weekend analysis, which covers the broader market, sectors, stocks, every single Saturday. We provide access to all of our investment ideas. I'll show you what that looks like in just a second. Access to our midweek halftime report. We also provide access to an incredible community. All of my chart books, which covers stocks, ETFs and commodities. And if you are somebody that's maybe new to technical analysis and systematic process, I also provide access to our technical analysis program, which I include completely free with all memberships. I used to charge a lot of money for it, but now I just include it as standard with all of our memberships. But just to show you what our high conviction ideas look like, this is an idea for Tesla. We have a quality over quantity approach, but again, very, very clear instructions on the chart. Of course, Tesla, massive winner. Meta, again, massive winner. Apple, recent alert that went out. TLT, this is a chart that isn't actionable yet, but I thought I'd share it in the analysis. If TLT gets above 109.50, then again, I like that one very much. But we are long and short, mostly long, I think, but with the Russell 2000, it was a short idea that did very, very well recently. And of course, stocks like Netflix, Amazon, ELF, which just unbelievable moves there. But I am very, very unique in what I do. I log every single one of my high conviction ideas on our website for complete transparency. I've done that over the last 5 years. Now, please do check that the types of stocks that I like to recommend are the types of stocks that you like to buy. I'm not recommending any low quality penny stocks. It's all high quality stocks. And the number of alerts, typically around 60, 65 high conviction ideas every year. And like I said, I've done that over the last few years, and of course made our members very, very happy. A lot of our members have been around and with me for the last 4 or 5 years as well, so I think I'm probably doing something right. But I think we're probably a good fit. I think if you are maybe mid-term in your approach, maybe the penny has dropped and you're not finding success with a lot of the day trading nonsense, maybe you want to learn technical analysis, maybe you just want to be part of a community, or maybe you're just too busy with work, family, life, business to hunt around for stocks and social media, you might find some value from my work. But as I said before, please do check out our website. Let me know in the comments, hit the like button, and if you are still here, thank you very much for watching. I hope to welcome you soon. Thanks.